This is why a market decline at age 35 is very different than a market decline at age 65. At 35, you still have decades of earnings ahead of you. You still have time to recover. You're still contributing money, which can benefit from those downturns. But at 65, the portfolio is now expected to support that retirement income, that paycheck for the next 25 or 30 years. That negative compounding problem is the entire conversation. The research shared a simple but powerful example using a $1 million portfolio. Imagine a retiree enters into their retirement with that $1 million and they plan to follow that William Benjamin's 4% safe maximum withdrawal strategy, and that would generate about a $40,000 per year average retirement income from the investment portfolio. But just before they retire, that market declines and that portfolio falls to $840,000. It's a 16% market pullback. That 4% withdrawal strategy now only supports $33,600 annually instead of that $40,000 income. This is a permanent reduction in that retirement paycheck caused purely by unfortunate timing. That retiree didn't fail, they didn't overspend, they didn't ignore saving. They simply experienced a downturn at the most vulnerable periods of their life. And this is exactly why adjusting your investments becomes so important in the years surrounding retirement. Here's one of the biggest planning mistakes I see when investors continue to treat their portfolios the exact same way at 63 as they did at 43. The investment strategy that helps you grow wealth may not be the same strategy that protects your wealth. Now, let me be very clear. This does not mean you should abandon growth. It does not mean moving everything into a protected asset. It does not mean making big adjustments after you've already experienced a decline. What this does mean is becoming much more intentional about how your retirement income will be generated during those difficult market times. This is where proper asset allocation matters tremendously. As retirees move within roughly 3 to 5 years of retirement, it is important to think about where retirement paychecks will come from. If the markets will struggle, this may involve treasury securities or bond ladders or lower volatility allocations designed to create stability inside your portfolio for the income that you're going to need shortly. The purpose is not necessarily to maximize the return.